Well, let's go ahead and get started. Thank you guys for being with us tonight. And thank you for showing up for yourselves. And thank you for showing up for us. We appreciate the support. This session tonight is basically the fundamentals. We want to give you guys enough information by the end of this call so that we can help you dispel all the myths about how much it takes to get started in commercial investing, how passive investing works. I think a lot of people assume that larger buildings cost a lot of money, and of course they do, but there's a way to work together to achieve those acquisitions. So again, tonight is 101 multifamily investing, and we're basically connected capital partners. My sister is my business partner, Ria. Do you want to say hi, Ria?
Hello, everyone. Glad to see everyone on. Excited about our partnership.
And so the goal of this is really, we strive to provide passive income streams for busy professionals. There's a lot of people that know that real estate is a great place to invest, but they don't have the time or expertise to jump right in. So for that reason, passive investing is a lot more attractive to some people. We'll talk about some of those pros and cons because maybe it's not for you, but I know for me, myself, I've always had two jobs, at least for the last 15 years. And when it came to real estate investing, I did not want to be a landlord. So I started looking at passive ways to get involved. And everything that I've learned over the last 5 years, I'll share with you tonight. And hopefully I can answer all of your questions. But if I can't, we definitely have the resources to get back to you and get you answers. So with that being said, let me share my screen. And if you have any questions, feel free to chat them to us and we'll try to keep up with that throughout the presentation. By the way, where is everybody from? I'm kind of curious about where you guys are logged in from. Can you drop it in the chat to us? I just want to see where our audience is.
I'm in New York.
Okay.
And Hawaii, Mary Lou, I see you. Okay. All right, cool.
DC area.
All right.
Oh, nice.
DMV.
I'm here in North Dallas area.
Where's that?
North Dallas, so Frisco.
Oh, Texas.
Yeah, Frisco, Texas.
Oh, okay. Gotcha. All right, cool. All right. Well, we want this session to be interactive, guys. We want to get all of your questions addressed. So feel free. This is a legal disclaimer. I only have to put this in here to protect everybody on this call because anytime you're talking about securities or investing, you have to let people know that there's always a risk involved. Of course, everything you learn here tonight will be the foundation, but you're going to do your own due diligence and we're going to show you how to do some of that. But definitely always do your own diligence. And there's always risk involved with investing money. All right. So again, I'm Yana Epps, also known as the Property Princess. And I started my investment company 5 years ago, Ask Me Investments. And I focused on wholesaling and multifamily investing. So wholesaling was a way for me to build capital to get into apartment investing. I always knew from the beginning that I did not want to own single family rentals. I was networked with a lot of people who were already in that business and they were looking to consolidate and trade up. And once I found out that you don't actually have to start with single family, I got really excited about multifamily. I'm actually lucky to be a third generation investor. So my grandparents were actually multifamily investors as well. And I had early exposure. So nobody actually held my hand and showed me what to do. But because I knew that real estate investing could provide a nice future for me, I knew that I had to get into it somehow. So I took it on myself to go learn the strategies that I wanted to do. So started my career in real estate as a lender about 23 years ago. And I got my real estate license about 15 years ago. And I'm still a lender. I'm still a licensed agent. I'm also an investor and a syndicator. And I actually am an agent under my sister, who is my broker. She's also the owner of Cotton Realty, but I'll let her tell her own story. So that's my background. And currently to date, I have interest in 244 apartment units. And this week, I'm actually purchasing another property in North Carolina. So that's me in a nutshell. And then most recently, we formed Connected Capital Partners because I knew that I needed a hand with the relations. There's a lot to it, guys. There's marketing, there's education. In order to get people comfortable enough to invest, you have to go through the process of educating them if they're not already familiar. So there's just a lot involved. And I couldn't think of anybody better to partner with than Ria because of her background and her experience. Now, she doesn't come from the investment world. She's more on the retail side now, but she just has a ton of experience in real estate, a lot of expertise, and a huge network as well. So I thought the both of us together would be a dynamic duo, and here we are. Rhea, do you want to introduce yourself?
Thank you. Thank you, Yana. Yes. Hello, everyone. My name is Rhea Cotton Landry, and I am the co-founder of Connected Capital Partners. My background in real estate started in savings and loans. So basically in saying that, in lending, I've worked in loan origination, which is sales, marketing, underwriting. So I'm experienced at evaluating risk as well as in appraisal, all through the savings and loan company that I previously worked with. I'm also, in addition to being a real estate broker, I'm also in the lending capacity. And I saw the need and the desire to move from first focusing on active investing to passive investing. About 5 years ago, I had some health issues and I accelerated the time that I decided that I would want to retire. And so I see passive investing as the best, most beneficial way for me to make the best use of my time and my energy. And so this partnership came right on time as far as my personal goals in retirement.
And I'm
So-
glad you made that point, Rhea, about accelerating your retirement, because ultimately the reason I do everything that I do right now is to also have more time. By creating passive streams of income, it would allow me to eventually get to the point. Everybody has their magic income replacement number, and you can kind of reverse engineer that to figure out how many individual rentals you need at a cash flow rate of X whatever dollars a month. But ultimately getting to that point where you can totally replace your active income with passive income is what we're striving to do. And we want to help others do that. So here we are. Now, we talked about creating passive streams of income. Of course, there's many ways to do that, but the reason that we choose to do it in apartments are because of the following reasons. So if you look historically, multifamily investing specifically has outpaced the stock market 2-to-1 since 2001. So what happened during COVID, if you're curious about what happens like during a downtime, ultimately when housing gets out of reach or more expensive, it pushes more people into apartments. Think about that. The demand is always going to be there for apartments because people will always need a place to live. And what happened during COVID was people were not necessarily moving out of apartments. There were some razor thin collection issues with people staying in units but not paying because they didn't have incomes, obviously. But it was able to rebound, and it did better than almost any other asset class in real estate during COVID. So another reason we like it is because it is a hard asset, right? If you're the type of investor who likes to drive past your property or know that there's a building there that's never going to go away, then real estate is a good thing. I don't know about you guys, but I played around with Bitcoin. I made some money, I lost some money. And for me, it was just way too volatile. I don't have the heart for that. I was like watching it every hour on the hour. With real estate, it doesn't work like that. There's more of a steady incline over time. And also by owning real estate, you're able to take advantage of certain tax benefits that you don't get with stocks. And when you look at acquisitions, it's just like buying anything else in bulk. When you buy apartment units, you're able to get them at a cheaper rate per door when you're buying a large asset. And because there are so many units, it also creates a little bit of diversification. Let's just use an example of a 300-unit apartment building. Typically, on average, apartments are generating twice as much as they cost to run. So the expense ratio should fall in the area of about 50%, if that makes sense, which leaves a lot of margin for cash flow. You don't necessarily get that in a duplex. And think about vacancies, right? If I have a couple people move out of a large apartment complex, then I'm only seeing small fractional loss versus if I own a duplex and I lose even one of my tenants, that's 50% of my income that I just lost. And going back to that magic income replacement number, if I can do the math and figure out I need to make X number of dollars and I know that I need to own 20 rentals, I'd rather do that under one roof because it's easier to manage versus having properties all over the place and different property management companies. Each time one of them has a failure with a system, you know, I have to replace a roof over here and an HVAC system over here. It's just a lot. So just like in the game of Monopoly, you consolidate your houses and you buy the hotel, right? It kind of works the same way in apartments. And forced appreciation is something that I'm going to talk to you guys about later in the deck. But I want you to know that commercial real estate works a lot different than residential real estate. So when you sell your house, if you put it on the market tomorrow, Your real estate agent is going to come to you and do a market analysis, and they're going to look at comparable sales within a close proximity, and they're going to give you an approximate value of your home. And that's going to be what they list it for in that neighborhood, unless your house has significant differences, right? So the market kind of dictates and drives the value of your house when it comes to selling it. With commercial real estate, everything is based on the income. And I'm going to show you why that's the secret sauce. And obviously you can scale faster and build a larger portfolio.
Okay, so let's get a little interactive here with what your goals are. I think I can see the chat now, but let's talk about, for the people that are on the line, what brought you here today? Have you just determined your income replacement costs? So have you thought about what it is that you need as far as income to retire? What percentage of your income? Please just share in the chat what percentage of your income that you are looking to retire on.
Or if you haven't figured it out, just be honest and say, I've never thought about it.
Exactly.
Let's see if
Can you see any responses, Yana?
yeah, I'm seeing 80%. Okay.
Okay, so we're right around the lines of the rule of thumb of about 75% of your annual income due to reduced expenses, but about 75% of your income to live off of a retirement. And that you should also have about 10 to 12 times of your annual salary saved by retirement. So hopefully, if you haven't, after this call, you'll take some time, do those calculations, think about what percentage of my annual income do I want to live off of? And if I do 10 times that, where am I in my retirement goals? And so this graph right here is just touching on the importance of investing. So as we can see, which everyone is aware of, our checking accounts don't have a large return, right? But on top of our checking accounts not having a large return, just having our money sit in a checking account actually decreases our money versus increases, because with inflation, your money is not worth as much as it is over time, right? So just keeping your money in a checking account, which we are probably all aware of, is not the best investment strategy. So then we're looking at the stock market. So on average, you're looking at an 8% return on the stock market over time. And then of course, your higher return is on real estate. So when we think about interest over time and investing and diversifying our money, and we're not saying put all of your money in the vehicle with the highest return, but diversify your portfolio so that you're taking advantage of various different income opportunities.
Absolutely. And so I think our minimum requirement for our money is that at least we keep up with inflation, right? At least we're earning at least 3% on our money, putting it somewhere. But that's not really the kind of growth that's going to help us stop working or retire. We really want to see how we can accelerate that growth. And this chart actually represents the power of compound interest. So think about even this chart zoomed out to 20 years, the growth rate is going to be a lot higher. So like me, maybe some people on this call don't have the luxury of time as much as others working for them, but it's never too late to get started. All right, so what is syndication? We talk about pooling our money together. That's all it is, really. If you were to get a group of people together and go buy an apartment complex, let's call it 10 units, you could do that with a couple partners, and you can actually set it up in a different structure under a JV partnership. In that scenario, it's really important that you understand the difference, because if I'm doing a JV or joint venture partnership with Rhea, for example, then I have to be responsible for something in that project. I cannot just give her my money and say, hey, Rhea, go do all the work and give me my returns, because then she's selling me a security and it's not registered with the SEC. So for those reasons, we cannot have joint venture partners if they're not active in the deal. Anytime you are collecting money from a passive investor, it has to be structured and registered with the SEC. and it has to be set up with legal documentation that protects you. So that's called a syndication. And you can have way more partners because, as you can imagine, some of these $50 million buildings might take a few partners to raise all the equity from. So the way it typically works is you go out to a commercial lender, just like you would when you're buying any other asset. And things have changed in the last couple of years. No longer are they lending you 80% of the value. It's more like 60 to 70%. So therefore that leaves a gap of 30 to 40% that needs to be raised from private equity. And when you do that, you may also have an additional budget that needs to be raised because we might have a specific business plan to come in and change out countertops, flooring. We might want to add some features or amenities to the exterior. Whatever that includes, we need to raise that from our investors as well. So we do that in a syndication. And let me see.
And also, Yana, you want to touch on the difference between a syndication and a trust, because I get that question a lot as far as what the difference is.
Yeah. So if you've ever heard of a REIT or a real estate investment trust, basically it's a company that invests in real estate, lots of different real estate. They don't necessarily tell you where, when, why, who, what, but they invest in real estate. So for that reason, some people like investing in REITs because it's not one specific company and one industry. So they like to, it's kind of like a mutual fund, but for real estate, and you don't have any visibility. So you're just buying into this company and become a fractional owner, just like with any purchase of any stock. And the difference with the syndication is you become a part owner in a specific entity that is set up to own one asset. So you become an owner of the building on title technically. And then for that reason, you get real estate tax benefits and other things that you don't get with a REIT. So one's like investing in a stock, while the other one is just like investing in real estate with a group of people. I hope that makes sense.
So Yana touched on the difference between a general partner and a limited partner. So we're going to take a deeper dive into what makes up the general partners. As mentioned, the general partners, their roles and responsibilities are interchangeable. But if you think of, in this scenario, think of this as an airline, okay? And as an investor, you're a passenger. So the limited partner is just a passenger. They're along for the ride. Then we have all of the people that make up the airline that gets the plane off the ground, right? So we have the acquisitions. So they're out finding and negotiating and finalizing the deal. So they're like the pilots that are navigating through your whole time. Then you have the underwriter. I like to think of the underwriter as an airline mechanic. So they are dissecting the plane, making sure everything is right, making sure there's oil, there's gas, there's no parts that need to be replaced, or if they do need to be replaced, what is the cost or the time that it will take to make those changes so that we're taking off in time. So the underwriter is really dissecting the plane. And then you have the loan sponsor, which is kind of like the gas for takeoff, right? And then you have the asset manager. There is security at the plane, TSA, making sure that everybody is protected and that all things are aligned so that there are little to no mistakes. And then we have the investor relations. So the investor relations are more of the marketing, updating with the newsletters, communication. So they're more like the airline stewardess that are making sure that the investors, which are the passengers, are comfortable during the flight.
Great analogies, Rhea. Thank you for that. Yeah, she's right. This is really a team sport. When I came into this business 5 years ago, just being who I am, I thought I was going to do every single aspect of this business. And I quickly learned that for the reasons that we'll get into on the next slide, my geography keeps me from doing about 50% of this stuff, but we have decided to focus on investor relations. So it's our job, basically, our business model at Connected Capital is we build relationships with investors. We also have spent the last 5 years networking with operators around the country, the people who are doing deals, active deals, and having a track record of success in these markets so that we can be the conduit for our passive investors and connect them with lucrative passive income opportunities. So thank you for summarizing that, Rhea. And so speaking of target markets, right, there are a lot of reasons why people choose certain markets to execute value add multifamily investment strategies. And a lot of it has to do with the growth in the population of an MSA. we want to be in landlord friendly states first and foremost, right? So everything in real estate is about location, location, location. And if you have a team of operators in a target market and it has good stats behind it, any single mistake or any type of hiccup is going to make less of an impact because you have the tailwinds of the market that are driving the demands, right? But if you go into an investment in an area with a declining population, you're going to have to work 2 or 3 times harder to see the same results. So we look for landlord friendly states. We look for business friendly states. And a lot of this has to do with just like legislation, to be frank. So I don't want to get political, but typically the red states align with most of this criteria. We look for steady population growth. Everybody has their different metrics of what type of population growth they want to see over time. But you also want to make sure there's a lot of jobs in that area and a lot of different types of jobs so that there's economic diversification. And if I'm qualifying a tenant for one of my units and I know they have to make 3 times my rent, I also want to look at the income growth and the median income in the area, because we need to make sure we're in areas that support the rents that we want to charge. And of course, we want to stay away from high crime areas.
Okay, so next we're going to look at how to select operators. So the operators are managing and selecting the deal. And so when you're coming in as a passive investor, you want to do a background check on how successful they've been, right? And so one thing that you want to see is that they've had a proven track record. So both of our backgrounds are in real estate. So that is like one of the first things that we do in any deal. You know, we look at the property profile, see how much a property is worth, how much was owed on the property, how many times has the property changed hands throughout the years. And then for the actual people themselves, what is their history and what investments did they have? And then doing the research, looking up, okay, you own this property in this state, looking up the property profile, then following it to the LLC, then following it to the ownership, like really digging in and doing due diligence on the operators. And then transparency and communication. So we have taken a lot of time to build relationships, and through that, we know how our operators communicate. How are they communicating with us on updates? How are they verbalizing or communicating their profits, their losses, their projections, their goals for the future, for how many properties they want to take on at one time, and can they handle it? Full cycle deals. So the average full cycle deal is 3 to 5 years. And so another process of vetting that operator is seeing how many deals that they have done full cycle, and then what was the actual outcome, positive or negative, in those full cycle deals. Also, deal structure. So is the deal structure something that is going to be lucrative for our investors? How are they structuring it? Are they looking to gain additional equity over time with their successes, and understanding how their underwriter is underwriting the deal? So if we're looking at the rental market, what reporting tools are they using to analyze the rents? What research have they done? What people they have in place near the property, what property management companies they have relationships with, and what is that property management company's experience in managing that property over time in that particular area that you may be investing. And of course, you want to always do your own research, do your own due diligence, get referrals on the people that you're working with. And Yana and I can refer you to tools on how you can do that research and the tools that we use, and you can do your own research using those.
Exactly. And I started as a limited partner. If you remember what that term means on a few slides back, I was a passive investor in my first deal. So understanding the type of transparency and communication that an investor wants, you want to know what's happening with your money at all times, right? So it's really important to keep your investors in the loop. And one of our strategies, speaking for Connected Capital Partners, is we've already talked about the market, which is the first criteria, right? And then the operator comes next, and then the building is next. So in that order, we have specific target markets that we want to stay within because we want to become local market experts. And we've identified 2 of our favorite markets to do business in. It's not to say that we would never look at opportunity outside of those markets, but we really love the Atlanta metro area as well as the Dallas-Fort Worth metro. And for those two markets, we have key partners that we work with on a long-term basis because we've already vetted them, we already know them, we already know their style, we've already done all of this research. And then when it comes to the opportunity, all we have to do is vet the asset and look at the numbers to make sure it's a good opportunity. And I think that strategy is working well for us so far, because if you guys have never underwritten multifamily investments, it takes a lot of research and a lot of time. So we don't want to have to do every step with every deal. Excuse me. And so the value add strategy is what we go for. So remember in the first slide when I was talking about the value being driven by the income, this is the secret sauce to commercial investing. I don't know a lot about Donald Trump, but I know that he invests in commercial real estate. And there, a lot of the big moguls this is the asset class that they specifically look at. Now, maybe they're looking at different types of commercial real estate. It could be storage, it could be commercial, retail, it could be warehouse. There's all different classes when it comes to commercial, but the difference between residential and commercial is that it's all driven by income. So you get an opportunity to kind of flip an apartment, right? Think about flipping a house. If I find an ugly house that needs some TLC, it's probably going to take me 3 to 5 months to go make it pretty and sell it for more. In apartments, it works exactly the same way. We look for value add opportunities, whether it's mismanagement or deferred maintenance or tenants that don't pay rent, a bad property management company. We look for all those opportunities to come in, fix that problem, even potentially make it look like the apartment on the left, make it look like the one on the right, and drive the rents up to increase which in turn is going to immediately give us the value add, because we don't have to wait for the market to swing. We can, let's say we take a $10 million building and come in and execute our business plan, which typically takes 3 to 5 years instead of 3 to 5 months with a house. And then we go back to the bank and say, hey, bank, we have increased our income by 30%. So now this $10 million building, assuming it's the same cap rate in 3 years, is going to be worth 30% more. So we're going to go back to the bank and it's worth 13 million. And we're able to pull out those proceeds in a cash out refi. And we'll talk to you about how that's a benefit to you as an investor as well, because you get some of those proceeds back without paying taxes, because technically it's on a loan. So that's a value add strategy. We look for that. So apartments are usually graded from like A being the nicest and newest to D being something you want to stay away from. And everything in between has to do with the age and the amenities of the property. So we typically look for the B and C class properties, and we try to fix them up and make them pretty. The A class properties, you're probably asking like, why do we stay away from that? There's not as much opportunity, because if something is brand new built, there's not as much opportunity to come in and fix it, which is the same reason why flippers don't buy brand new houses to flip. So
sometimes on the A properties too, there are some opportunities such as adding amenities.
Exactly. So anything that increases the income or lowers the expenses ultimately is going to increase your bottom line. And that's called your net operating income. So in order to determine the value of a building, and I don't want to get too far off into formulas, but if you take your net operating income and divide it by the local market cap rate, which let's say an average of like 5%, it gives you the value. So if you're able to drive that NOI, then your value goes up, and you can do that within months. It doesn't have to be years. So.
Okay, so now we're going to talk about how people are protected and what protects private offerings. So the SEC, or Securities and Exchange Commission, defines rules on which these offerings can be solicited, advertised, shared, invested. And so we're dividing here on this screen between an accredited and sophisticated investor. So an accredited investor is basically, there's rules set on what is an accredited investor, and that is $200,000 annually as an individual, $300K annually as a married couple, or proving that you have a $1 million net worth excluding your primary residence. Okay, so alternatively, we have the 506B investor, which is the non-accredited sophisticated investor that has the sufficient capital, maybe has no experience in investing. So basically, what does that mean for investors and for investing in deals? Well, investors can actually advertise and market 506C deals to accredited if they're an accredited investor. So they're able to market, whereas a sophisticated investor, 506B build is going to be more of the family and friends deal, where you're getting people that you have close relationships with together to invest in a multifamily apartment complex. So basically 506C is more mainstream, 506B is more family and friends. You're basically building off of the reputation and the trust that you have with the people that you know when you're making your initial investment. And Yana, you want to add to that?
Yeah, so like Rhea said, knowing how to find, let's say you have money saved and you know that you want to get started in real estate. So this is one thing that I do want to address. How much does it actually take to get started in a multifamily deal, right? That number is going to vary from deal to deal. It all depends on the team, the active team, the GPs, and how much equity they're trying to raise. It could be as little as 25,000. It could be 50,000 minimum investment, 75, 100. It's going to look different from deal to deal. The biggest thing is the criteria. Which ones can you participate in if you don't meet the criteria of being an accredited investor? And if those deals get publicly advertised to any and everybody, you'll know all about them. But how do you know about the opportunities for 506B investments where you can still invest if you don't meet the criteria? Well, you have to be connected to someone like us or be in a network where you have people doing deals that can invite you in to participate. And so ultimately the returns look the same, generally speaking, and there's no difference. It's just that one can be publicly advertised and the other one can't. And the reason that these rules are in place, it's not our rule, right? Like she said, it's the SEC that determines if you make a certain number as your income, then you probably have a higher risk tolerance, because again, going back to the disclaimer, there's always risk involved with investing money, and they feel like if you make at least 200K a year that you can take the hit, if you will. And so what does it even look like when you get invited? How do you know about a deal? What are the steps, right? So like we're on this call tonight talking about fundamentals in general. We have similar webinars where we have an active deal that we would come on and bring people on all at the same time. We would show the investment highlights, talk about the management team and their experience. We go into the market details and show you some of the data that supports why we like this opportunity. And we also get into the returns and the investment overview, like how much money you're able to expect back. We won't say guaranteed because nothing is guaranteed, but what can we project as the return, and how would you get your money back? And I see that question, how is the income verified? So there are actually third-party services that will give you a letter of accreditation. So you can pay like $500 to get that if you don't have it already, or you can just provide those documents to support your income too. It's not necessary to always have the verification, but the return summary, talking about whether it's what type of returns we're looking to provide, and also the investor criteria, whether it's a 506B or 506C. And then we talk about the next step. So for people who are on a webinar with us and they like the deal that we presented and they want to know how to get started or what the next steps are, we have an investor portal. It's pretty simple. It's like a 3-step process. You just go in and build a profile, and then you can click on the deal that you want to participate in, and then you just connect your bank account to ultimately wire the funds right into the bank account for the property. So we make it pretty seamless. We try to make it easy, but then also following a webinar like this where there's other people and you don't really want to talk about your own personal finances, you can also book a calendar appointment with Rhea or myself to talk about your own personal goals, and we can hash it out. Like, make sure you're ready to invest, make sure you understand everything about investing, and then talk to you about your own financial goals. I take pride in working with investors that aren't there yet. So it's really important to me to help people understand the basics and get introduced to this idea of building wealth through investing instead of spending our money on things that don't benefit us in the same way. And I think it has a lot to do with mindset. So I'm even open to like helping people develop that mindset about making sacrifices, because a lot of times we feel like we cannot come up with the $25,000 or $50,000 that it takes to participate. But if you really were to make a lot of different sacrifices, it could be that you have the ability, but you haven't made the sacrifices yet. So we go through all that. We like to be resources for investors at every level, if you will.
So now we're talking about deal structure. So the investors are key to most investments. The investors are getting a majority of the equity share out of the deal. So on this diagram, you're seeing that the investors are getting 70% of the equity share, where the general partners are getting 30%. Now, this is not a standard. Each deal will be different, and there's no set amount as far as how it's set up. So this is the basics. This is a basic deal structure where you're just looking at a straight split. There are other deal structures that you'll find where the general partners, because they're doing all of the active work in the deal over time, you'll hear terms such as hurdles or waterfalls, where they're basically incentivizing themselves to basically exceed what your expectations are in a deal. So after they meet your expectations, then they exceed it. After they exceed it, then they may put in additional parameters in your agreement that you'll see. And so it's like another way, we talked about protection. You'll have an agreement that will a legal agreement that will spell out all of the ways in which, if you exceed what your expectation was in investments, what happens with that additional equity or those additional funds? How are they allocated? It's all spelled out in your contract. So that's another important thing that you will want to do, is definitely take a time with each deal and see what the agreement states as far as how equity is shared.
Exactly. And then when it comes to returns, again, this is something that's going to vary from deal to deal, but I think on average, what most syndication teams or sponsors try to provide is a return of, I would say, this slide, I actually made it before the market shifted. 20% annualized returns is still achievable in some markets, but I think a more realistic expectation, now that the lending requirements have changed and interest rates are a little bit higher, is about 15% annualized. And the internal rate of return has to do with the value of the overall investment over time. So there's a formula that I won't get too far into it, but it basically measures your cash and the value of the cash return over time. And then different investors are hung up on different metrics. So some people look at the overall annualized return. Some people care about how much cash should I put out and how fast am I getting that cash back in my pocket? So the initial cash investment return to you is called the cash on cash measurement. And a lot of people are really fixated on that. So again, most deals will at least intend to provide an 8% cash on cash return. And so when you're underwriting these deals, it starts from the moment that an opportunity is identified, right? It goes to an underwriter. The first step is an underwriter is going to take a quick formula, look at the deal, see if it even makes sense. And then from there, if it does make sense on paper and the numbers actually work, the next step in due diligence is going to physically walk the property. So sometimes that means flying into a market to go actually look at a property. You want to see a certain percentage of all the units so you can make sure it is what is represented to be. And then from there, you submit a letter of intent, and ultimately leads to a purchase and sell agreement. So it's like any other process. When you're buying a house, you have your inspections and you want to make sure the numbers work, since this is all driven by income. So underwriting is very key when it comes to these acquisitions. But when we're underwriting, we want to make sure that these numbers look reachable or attainable, because that's what makes it a good deal. Of course, there could be things that change or variables, but if it at least pencils and shows that we can provide these returns, then that's a good deal.
Okay, so let's put some of these terms into action in a scenario. So on this scenario, you have an initial investment of $100,000, okay? And this is spread out over 5 years for a 5-year hold time. So year one, you get 10% return of $10,000, and you're getting a consistent 10% year 1, 2, and 3. Well, during those first 3 years, that the general partners have worked to upgrade the property. And so they've made significant upgrades, and they're able to actually do a cash out refinance and provide you with your initial investment after year 3 back of $100,000. So in this scenario, at year 3, you're actually getting back your initial investment. Okay. And then with your annual percentages, the 10% is reflective of the rent. So that's the net income after expenses that are paid out to you either monthly or quarterly. Again, your agreement that you have at the initial stage of your investment will tell you how often those payments are paid out, but they can be monthly or quarterly, annually, but 10%. And so now you've received 10% for the first 3 years and your 100,000 initial investment back, you're winning, right? So then we continue on to year 4 and 5 with that consistent 10%. At the end, it says the disposition or sale. So after the sale of the property in year 5, your portion of the net equity that is distributed is $50,000. So you have your $100,000 back. You've made $10,000 annually for a 5-year period, and you had an investment at a return at the end of $50,000. So that's what's considered a 2x multiple, because you basically doubled your money. And it's also, the COC is representative of the cash on cash return of 10%, and your annualized return in this scenario is 20%. Yana, you want to add anything? I gotta charge my phone. My computer.
I want to know if anybody has any questions about this, because this one is really the best illustration to help you conceptualize what it looks like to put your money in and how you get your money back. So there's 3 ways that you get your money back, right? The preferred returns, the 10% that she's talking about right here, is basically the rents that are collected after all the expenses and the debt is paid. You get 10%. And by the way, investors get their returns before anybody on the active team gets paid. So that creates an incentive for us to produce the returns that we project so that we can not be working for free. So I just wanted you guys to know how that works. Investors are right behind the lender in the capital stack, meaning we have to pay our mortgage first, and then we have to pay our investors. And then if there's anything left, the active team gets to eat a little bit too. So again, with the value add strategy, you're not always going to see a capital event here in the middle of this timeline, but at some point in the middle, when you're doing a value add and you've increased the value, the goal is to go back and do the cash out refi and share those proceeds, tax-free proceeds, with your investors. And we aim to at least give you back your initial investment at that point. And again, this is going to look different from deal to deal. Not all deals have a preferred return. Not all deals have equity, and they're all structured different, but we just wanted to give you guys an illustration so you have a better idea of what it looks like and understand some of these terms. Does anybody have any? Okay, Nicole has a question. Is the minimum, wait, I missed one. Could you go over distributions and returns represented with this slide again? Yes, is it this slide that you're talking about, Tamara?
Yes, I just wanted to fully understand. I didn't quite understand how, when the person got their money back, the first year they get $10,000 back. Is that correct? And then 20,000.
So assuming there's a preferred return, right? If that's in your documents and that's one of the ways that you get paid back, that means you're getting 10% of your initial investment back in the first year. That $10,000 could be paid monthly or quarterly. So if I'm doing the math right, you get monthly payments of $800 times 12, or you get quarterly payments of $2,500 times 4. And that's going to be how you get the $10,000 back in year 1. And that's, again, that's from rents. Does that help?
Right. So are these numbers like year 2 and 3, you get 10,000 the first year, an additional 20,000, or is it a total of 20,000 the second year?
It is 10% each year as represented in the box.
Got
so
it.
It's
Those are
cumulative totals.
Got it.
Yeah, I figured that's where the question lied. We should put something there.
Okay, maybe we can fix that. Thank you for that feedback.
Yeah.
So we want to make sure it's like understandable. And so then you have a question here. Is the minimum you accept 100,000? This is just an example for sure. There are different deals that we're working on. They have all different levels of a minimum investment. And again, I've seen it as low as 25,000. So for those of you that are still working to accumulate savings, maybe that could be a target investment goal. And for those of you that have a lot of savings already and you want to get started. So I even have investors that want to put large sums into deals. And it's always my recommendation that as much as possible, you want to try to diversify. So I try to give sound advice. This is what I would do with my money. I'd rather have a couple eggs in every basket, if that makes sense, rather than putting all of my eggs in a single investment. So are investors paid out after 3 or 5 years, or do we get the money after 1 year of investing? So again, you're getting the rents back every year, either on a monthly or quarterly basis, your percentage of the cash flow. And then if there is a capital event, because not every deal has a refi strategy built in, if there is a capital event, it usually takes place within 2 to 3 years, because that's about how long it takes to get into the units and turn them over and do the rehab and execute the business plan. And then we give a window of 3 to 5 years on the overall hold, because it could even be that at year 3, the market's hot and it's time to strike. This is when we need to sell this property. So it could be as low as a 3-year hold. But if the operations team, the decision makers, decide that we need to wait another year, 12 months, 24 months, there's a window so that we have that ability to make that call. Does that help? Okay. So now pros and cons, right? We're talking about passive investing here. Like Rhea said earlier, you're the passenger on this plane. You don't have the ability to say, hey, there's a storm ahead, reroute, navigate. You don't have any decision-making capabilities. You're basically trusting other experts, a team of experts to produce the types of returns that you anticipate. Why is that a good thing? Because if you don't have time or the expertise and you don't mind relinquishing control, these passive streams of income can really help you build wealth over time. Now, it also provides for a certain level of diversification, because collectively we can buy bigger assets, which produce more income. Strength in numbers, right? Where's my local Bay Area fans, Warriors fans? That's our motto, strength in numbers. So it actually applies to real estate too. And also they produce more cash flow. And of course, with any type of real estate investment, if you look back historically, it's going to appreciate over time. That's what real estate has continued to do when you zoom out. And you get tax deductions. And these are just general pros of investing in real estate. But some of the cons may be, maybe you're the person that needs to pick the paint color in the tile. Maybe you don't want to give up any control. And maybe you're the kind of person who wants to see returns on your money in 12 months, not 3 years. And apartments require a very specific buyer. So they could be considered a little less liquid. And again, you don't have any decision-making ability. So you have to really think about those factors and decide if a passive investment is something that is right for you.
Okay, so Yana mentioned earlier the initial cash investment is usually somewhere around 50,000, possibly 25,000. And so as you're going through this presentation, you may think, what funds, where do I have money to invest? I'm interested in investing, but I don't have the cash available. Well, you want to basically look at all sources of money. And that could be in addition to cash. So that could be possibly an equity line of credit. So definitely you want to weigh out the interest rate and the cost of that money in relation to the investment that you're making, but and business line of credit as well. Financing private, so it may be a family joint effort of family putting together their funds to create that $50,000 or that $100,000 investment jointly together. Retirement accounts, and maybe there are some investments that you can liquidate to make use of your investing. So definitely think about the resources that you have available. Get creative if you need to just get started, and then grow from there. And there's a lot of trending. What's trending right now is a lot of groups either within the family or within social circles that are coming together and doing investments. Maybe even industry professionals that are in the same industry are coming together to pull together their funds and investing. So the opportunities are out there if you're willing to take that leap of faith.
And so, like Rhea mentioned, it's more than just your savings account. You have all these other resources that you could consider. We have a custodian coming on to talk about how to use retirement accounts in a couple months, I want to say. So it's on the calendar, but we want to also give you guys the tools to understand how that works when you're using like your IRA or taking loans from your 401k. And just creative financing is a strategy that is going to separate the experienced investors from the non-experienced investors in this climate, because like I mentioned earlier, lending is really strict right now. The interest rates are high, but there's lots of ways to assume property without even having to use a bank. So if you know those strategies, it's going to really differentiate you. And so we talked about the one-on-ones. If you guys feel like you want to have a one-on-one conversation, maybe talk about some of your goals, feel free to use your QR reader or your camera to scan this and book an appointment with us. We're happy to have those conversations. And eventually, if you're not already in our network, we could also potentially invite you to participate in some of the deals that don't have that criteria requirement. Or if you are an accredited investor based on the income levels that we mentioned earlier, we could help you get in contact with a third party to get that validation.
Right.
And I'm going to page forward.
Okay, so the next QR code are for those that say, I'm ready to invest. So your goals may be 0 to 3 months, 3 to 6 months, 6 months to 12 months, but we have opportunities available that are ready for you now. And so if that is of interest to you and you want to see what's available, and like Yana said, set an appointment with us, this QR code is actually a link to our portal. So during the process of setting up your profile in the portal, you'll be able to basically set up the amount of money that you're looking to invest. In addition to setting up that amount, you can actually look at the deals that we have available for you to review. Also, this portal is going to be an ongoing tracking system for you, so you're not left in the dark. So newsletters, marketing, updates, what you need to know, how your investment is performing, is all going to happen through this portal. So you don't have to wait for a phone call from Yana or I to tell you where your money is. You can see how it's performing through the portal. So please set up your profile and you can start the process there.
And if you haven't done so already, we would like to invite you to join our Facebook group. As I mentioned earlier, we try to provide value through education. We don't consider ourselves to be experts in all facets of multifamily investing, but we know experts in all facets. So we bring in people that can talk about tax strategy. We have someone that's going to cover multifamily underwriting if you'd like to have a better idea about how that works. We just try to provide value through these webinars so that the investor gets a little bit more comfortable with the idea of investing, and eventually you would just decide that you've learned enough that you want to participate. So we also have live networking events that we host on a monthly basis. They could be either our webinars or in-person events. So on April 19th, we actually have a social mixer coming up in San Francisco. For those of you that are local, it's going to be a lively environment with a cash bar, and we would like to invite you guys out to come and meet us in person. And we're putting that on with some partners, so there should be a nice turnout. And I think this is how I kind of got started in investing. When I did not know anything about investing, the first thing I did to take action was to show up at a meetup. And by sitting in the room with people who are having these conversations around me, I eventually learned the language. I kid you not. There were times where I had to text myself certain words because I didn't know some of these terms, and I was curious about learning what they were talking about. So I would go Google it right when I left these meetups, and eventually it became second nature. And now I'm what I consider to be bilingual because I can speak finance now, but I couldn't do that as much as I can now 5 years ago. So learn, read some books. I went to YouTube University. I'm a proud graduate. Actually, I don't even want to call myself a graduate because I'm still a student. I'm learning every day. But these are some resources and just ways to kind of get involved and get inspired by other people's journey. I've seen people start investing in real estate and completely leave a W-2 job in 3 to 5 years. And that's exactly what I want to do. So I'm happy to connect with you guys in person if you want to join us as well. But that is pretty much it for our presentation. I want to know if you guys have any questions.
And thank you all for joining and staying to the end. We love your feedback as well. So you'll be getting some information or a survey from us to see what you would like to see in the future. And if this was helpful for you, please share with a friend.
Does anyone have any questions for us?
I have a question.
Yes.
Thank you for all of the value this evening. It was a great presentation. So there's been I mean, obviously with the market sort of being in flux and so much uncertainty, I'm just curious as to what your projections are as to the multifamily space. If there's a lot of conversation about the United States slowly becoming a renter's nation. So I'm just curious as to how you both see the future, and maybe over the next 10, 20 years of multifamily in lieu of those dynamics currently?
Well, if you look at the trends and what they're predicting, I'm not an economist or anything like that, but there's the millennial generation that has decided they don't want to buy homes because they don't want to be static. They want to move around and they want to rent. That's just the sign of the times. And then you also have that silver generation of retirees, the baby boomers that have now started to retire and they want to become more mobile in their journey as well. So you have older people selling homes so that they have more flexibility to move around. So with the shortage of housing, it's only anticipated that the rental demand will continue to grow and grow and grow. Right now, we have a huge shortage of housing in this country. If you're not familiar with that, just go look it up. The numbers speak for themselves. Demand for rentals will always be there, and it's just growing exponentially year after year.
Yeah, and I just want to add to that, in addition for the demand for rentals, the reason why we focus on multifamily apartments is because of the demand for rentals. And some operators get specific. So there's a demand for rentals near schools and universities. So universities have housing demands for schools. So some people focus on apartment buildings that are around universities, in addition to affordable housing. So affordable housing has very long wait lists. They're solid investments because you're going to get your rent paid. Those are the most paid rent during the pandemic was affordable housing because it was paid out by the government when people were not receiving income. So we're choosing multifamily apartments because of those reasons.
And there's demand and it's only growing. Precious, do you want to ask your question?
Yes, ma'am. Thanks for doing this. So what if we are ready to start investing now, through the portal? Is it going to automatically tell us however much money we put down? Is it automatically going to tell us what our return is going to be, or how does that work?
Well, the next step would be if you were to participate in one of our current deals, you'd probably want to jump on a call with us so we can outline the details and see if the opportunity makes sense for you specifically. But yes, all of that would be outlined. And somebody asked a question earlier, are the active partners required to invest? They are not required to, but I invest in my deals. So skin in the game is important to me for that reason. I try to save my capital so that I can invest side by side with my investors in every deal. So I intentionally, like I told you, I was a passive investor before, but I have intentionally stopped taking those opportunities on because I want to save my capital and be invested with my investors. When becoming a passive investor, should you register for an LLC? So no, you don't have to. There's really no other reason to register for an LLC other than to protect your liability, limit your liability. That's exactly what it is. So you don't have to become an LLC to participate. You can just provide your social. If you have an entity already, you can definitely invest as an entity, but it's not a requirement. So again, when I talked about dispelling some of these myths, the credit requirements that it takes to purchase real estate on your own kind of go out the window. And the income requirements are still there sometimes depending on the deal, but this really allows pretty much anybody to jump right in and you become a part of a bigger team. And what happens is technically, like I said earlier, the entire team becomes one entity and you have fractional percentage of ownership in that entity, which owns the building. And that is spelled out. I saw another question about, is it disclosed before the deal? So yes, in your PM, which is the legal document, it does spell out what an investment equates to in terms of shares. What else, guys? Okay. Now you guys know how to find us and we would love to connect with you guys. So like Rhea said, at least go in and build your profile and let us know what your timelines are so we can work with you to get to that point. There is absolutely no pressure. I think of this as like a bus line. There's going to be a bus every 30 minutes. You're not going to miss any opportunity if you don't jump in right away. We just want to make sure you are 100% comfortable with any investment that you make. So don't feel like we're not here to create scarcity or try to drive any urgency. You can jump in whenever you're ready, like Double Dutch. So.
And how do we access the portal, or is there a link or something?
Maybe you put the link.
Yeah, let me put it back. Yeah, hold on, give me 1 second. I'll just drop the link. How many of you guys on the call actually have been a landlord before? Nobody? Okay. Well, personally, I don't like the idea of being a
I
landlord.
actually have a duplex right now. So, and then me and my husband are working on getting another one in August, but we're also interested in doing the syndication deals as well. So we're still learning because this is our first property. So yeah.
Yeah, and honestly speaking, there's some benefit to having a greater ownership interest in owning your own property, but at the same time, you're taking on all the risk. And if you are not an experienced landlord, it can also be, you might have a rough journey and experience some costly mistakes. I'm not saying that will happen to you. I'm just saying for those reasons, some people just decide to lean on the expertise of experts. But I think there's benefit in both. I too want to grow my portfolio with smaller assets so that I have greater ownership interest as well. So we'll be doing some of those projects on a smaller level, which is another reason to be connected to us, because when we form JV partnerships with just a handful of partners, we would be looking for people who are ready to do active work on these deals, but we could own the property outright instead of with a group of investors as large as a syndication. So I see benefits in both scenarios. All right. Did you have a question, Payush?
Hey, yeah, I was just raising my hand when you asked who has been landlord before.
Okay.
So I bought my first single family in 2005, and since 2017, I bought I bought a retail center during COVID in Bay Area, California. I bought some out of state educational triple net properties. So I'm a landlord, but they are triple net, so they are managing the property, and I'm just
Exactly.
collecting rent and just collecting rent. So I have some experience.
That's
But,
awesome.
I would love to. I just heard JV. What is your goal in JV deals? Will it be long-term investment, or will those be still, like 5-10 year flips?
Long-term buy and hold, whatever the market demands. If there's an opportunity to get out of it at a certain time and realize our profits, then I think collectively, which is why JV partnerships work better in small groups, like up to 5 partners, because the 5 of us can make that decision together. And that's the difference. So definitely looking to do some of that as well. And what he's talking about, triple net, you guys, is like if you have a retail space and you have a corporate tenant that moves in, they pay for all the taxes, the maintenance, and the mortgage. So you absolutely have almost zero responsibility, which makes being a landlord a little bit easier in those scenarios. And just to give you guys a glimpse into the future, so right now we're doing deal specific syndication. So one by one, we're looking at opportunity and we're considering these opportunities for our investors. But a year from now, Ria and I will have a customizable fund, which will give you access to our dashboard. You would be able to log in. We're going to grow into other asset classes. We don't want to do that immediately because we want to become experts in multifamily and the markets that we invest in. But over time, we do want to offer diversification options, meaning we would look at other asset classes such as commercial retail, triple net opportunities. Self-storage is a great opportunity. I'm investing in a luxury RV resort right now. So there's all kinds of different ways to break it up. But multifamily is the strategy we're most familiar with because it has a lot of opportunity. So, and a lot of demand. Think about how people make money in Airbnb. There's a lot of people doing really well, but what happens when there's a recession? The demand kind of goes away overnight. So you just have to pick and choose. What else, guys? All right. Well, if you guys have any follow-up questions, please feel free to reach out to us. You have our link here. You have our calendar. Let us know how we can help. We just want to be resources for you guys. Thank you guys for joining us tonight.
Thank you. Have a good night.
Thanks again.
You're welcome.
Thank you. Thank you very much.
Yeah, thank you. Great presentation. Thank you.
Yes,
Thank you so much.
very informative.
Thank you guys.
Bye-bye, everyone.
Good night.